So I'm continuing on part two now. So basically what happened here, and it's important that we look back to chapter 10, okay? So on chapter 10, there was a lot of discussion about government safety nets, such as like deposit insurance, and basically what happened, they weaken market discipline because they always, the moral hazard says the government's always going to be there. And basically the banks will take on greater risks, and then there'll be adverse selection because the other people, lenders and savers, know that basically government guaranteed insurance protects them from losses, and they will supply even undisciplined banks with funds without proper monitoring. Basically risk taking grows unchecked, and eventually losses on loans begin to mount up, and the value of the loans, they begin to fall, relative to the liabilities. And basically with less capital, what happens is these institutions cut back on their lending, and lending stops, and basically there's a process, as in your book says, deleveraging, right? So that's kind of what happens. All right, so here's a figure from your book, and this is stock price data during the Great Depression period, okay? So here's the date. Here's 1929, and the stock market was kind of flying, right? So basically, you use 1929 as the peak here, let's say. Around 2930 as the stock market peak. And then things started to really come down. By 1932, look at the stock. It was down to 10 cents on the dollar, right? 10% of the September 1929 peak value. Okay, so you can look at this. This is the Dow Jones Industrial Average here. And again, here's the nice links they always give you. You can actually look at the historical data on these links. Let me see. I don't know if these things will. I don't think I can click. Let's see. Control click. Let's see if I can open this. No, I guess it don't. Control plus click to follow link. Let's see if I can do that. Oh, here we go. So let's see where this takes us. Okay, I guess it ain't there then. So I don't know why, but I guess it isn't there. All right, I would like to have seen, but you can find that data on a lot of other spots. Okay, so here's credit spreads during the Great Depression. So this is junk, right? This is junk versus U.S. Treasury spread, roughly junk, right? Maybe speculative a little bit, but and here's the U.S. Treasury spread, right, versus the U.S. Treasury. So you can clearly see the uncertainty around 31, 32 increased the spreads between corporate and low risk, but basically, even though they were low risk, it wasn't basically solid. It wasn't junk, but it was bonds that were considered low risk, but not the greatest, right? So anyway, right here is where they peaked out the biggest credit spread here. All right, so what caused the 2008 or so, 2009 financial crisis? So there was a lot of financial innovation. A lot of products were developed that emerged in the mortgage markets. And as I said, there was these subprime mortgages that had they were risky mortgages that were pretty low rated. And there was these things called mortgage-backed securities, as I mentioned. And they bundled all these mortgages, and then they created these things called collateralized debt obligations. Okay, and these interesting products here were bundled with a couple of good mortgages, AAA rated, and then a bundle of poor mortgages. And basically, eventually, prices kept going up on housing, and then interest rates started going up, and a bubble formed. And there was an increase in liquidity from cash flow surging to the United States. Money was dumping into houses. And the subprime mortgage, they were giving mortgages to anybody back then. Then the development of subprime mortgages market, it fueled the housing demand and housing prices, and they kept going up because you could see the liquidity coming into America. Now, on a first-hand note, I know people who were making maybe $40,000 a year, and they were taking $400,000 mortgages because they said, well, mortgage rates, housing always goes up. It always goes up, and I'll sell this house, make $100,000, and then I'll have next year to fall back on. And then agency problems arise, right? There's this originate to distribute model. And there's a lot of problems between investors and the mortgage broker. So there was a lot of money trying to be made between the broker and the investor here. And as I said, borrowers had little incentive here to disclose whether or not they had the money. They could be making $40,000 and they would get a $500,000 mortgage, and they didn't even have to disclose their ability to pay. It was just kept secret. So commercial and investment banks had weak incentives to assess the quality of the securities, and information was being held and it surfaced. The fact that information wasn't coming out, and the housing bubble bursts. Boom. Interest rates go down. People can't go up. People can't afford the mortgages, and they run away from the house, and the banks are left holding bad mortgages. So all these asset-backed securities that were full of subprime mortgages really take a hit in value. And Bear Stearns and Lehman Brothers had a lot of them. Okay, so basically what happens is there's a thing called the collateralized debt obligation here. And the creation of this collateralized debt obligation involves a corporate entity called a special purpose vehicle. And what that does is it buys a collection of assets such as corporate bonds and loans, and commercial real estate bonds and mortgage-backed securities. And they start separating the payments from these assets into like what's called buckets. And these are known as tranches. And these tranches have a value. Okay, so I'm going to see if I could, I will see if I can bring up some information on what these collateralized debt obligations are.
We've seen that an investment bank can buy a bunch of mortgages, which essentially makes them the lender to the homeowners, and then it could stick those mortgages inside of a special purpose entity, and then it could sell the shares in that special purpose entity, and that these shares would be called mortgage-backed securities. And let's just say, just for the sake of argument, when it sells these shares, it sells them at $10 a share, and it promises dividends that's at $10 a share, the equivalent of an 8% yield. So maybe the homeowners here are paying a higher than 8% interest. Some of them default once you average everything out, and the investment bank keeps a little bit for itself and to do all the operations and all the overhead, and so it can actually give the investors an 8% yield. This might be good for a whole class of investors. They might like the safety profile, the risk profile of this special purpose entity, of this mortgage-backed security, and they might like the return, and they might go for it. But there might be a class of investors, maybe very risk-averse investors like pensions, that says that this mortgage-backed security is too is too risky. They've looked at what we're holding and they're like, hey, some of these are subprime mortgages, some of these are shady, some of these are to risky borrowers. I don't like where this is going. And even if they can't look under the hood to see what this is, the investment bank might have hired a ratings agency. So ratings agency to essentially look under the hood and tell investors what's there. So the rating agency might look at this special purpose entity and look at these securities and say, look, I would say that these securities should be rated double B. So not super safe, but not super risky either. But for pensions, that is not safe enough. Now, on the other hand, you might have people who want more risk. So you might have, maybe there's some risky hedge funds, and not all hedge funds are risky, but let's say that there are some risky hedge funds, and then they say that this yield is too low. Yield is too low. And the investment bankers, they're very creative people. They say, well, look, here's some people who want to buy securities, but these securities are too risky for them. And there's other people who want to buy securities who are able to take on more risk, but they say the yield is too low. So instead of losing out on these investors, why don't I just split up this special purpose entity in a different way? Why don't I split it up into tranches? So instead of all of the securities being the same, why don't I put them into classes? So why don't I put them into classes? And they're so often called the senior tranche, the mezzanine tranche, I'll just write mezz for short, or the middle tranche, and then the equity tranche. And the way it works, in a mortgage-backed security, everyone gets paid the same amount. In this situation, when you split it this way, the holders of the senior tranche securities are going to get paid first. Only when they're made whole are the owners of the mezzanine tranche securities going to get paid. And only when they are made whole will the owners of the equity tranche security get paid. And this scenario right over here is called a collateralized debt obligation, CDO. And it's really a derivative security from the mortgages. We've sliced it and diced it in a slightly different way. Now you might be saying, how does this solve the problem? Well, now the ratings agency will say, well, look, if the senior people are going to get paid before everyone else, then I'm going to give them a higher rating. And they can even get insurance on this and get a credit default swap, and then maybe they'll give it a AAA rating, which means that the pensions can now buy the senior rated CDOs. But they'll pay them less interest. Maybe they'll pay them 5%. Maybe the mezzanine, they get paid next. They'll get maybe still a double B rating, and they'll get the 8%. And then the equity tranche, they'll get a higher interest, so they'll get say a 15% interest in exchange for being the last person to get paid. And maybe they don't get any ratings at all, so you can almost view this as a junk rating if you want to view it that way. But that makes both people happy. Pensions get something safe, lower yield. Hedge funds get something risky, but it has a higher yield.